Hello investors, this is Lukasz Labedzki, Senior Analyst at the Franklin Templeton Institute. Each week we'll cover the most important developments for investors, we'll look at what happened and how it impacts the markets so you can make smarter, more informed investment decisions. Lately, a lot of ink has been spilled over the US military intervention in Venezuela, which is directly related to one of the segments we cover, emerging markets debt. So, today, let's take another look at the case for emerging markets debt. The reaction of bond markets to recent events in Venezuela has been generally positive. Some investors may have expected a rise in risk premiums, leading to a broader sell off in Venezuelan assets and possibly across the region, but that hasn't happened. In fact, Latin American bonds have performed well this year. Local currency bonds are up more than 2%, while hard currency or dollar denominated bonds are up around 0.5%. That's more than what we've seen in emerging markets' broad bond indices. Venezuelan bonds themselves have risen by more than 20% year to date and at their peak were up over 30%. Here we are talking about dollar denominated bonds because bonds issued in bolivars are effectively inaccessible to foreign investors. So, why is this happening? Venezuela defaulted on its sovereign debt back in 2017, and since then there have been virtually no meaningful negotiations. Against that backdrop, the removal of Maduro is being seen by markets as a marginal improvement and as a step toward some form of debt restructuring. However, make no mistake, any restructuring process will be complicated and lengthy, and political risk in Venezuela will remain high. Political risk also matters for the wider region. We have elections coming up in Colombia and later this year in Brazil. Still, we don't believe political risk alone should paralyze investment decisions. It's important to take a step back and do what we usually do, focus on fundamentals. It's been a stellar year for emerging markets debt, both for local currency bonds and for US dollar denominated bonds, as this slide shows. The slide also breaks total returns down into their key components. Looking ahead to 2026, it will be challenging to repeat the results we saw in 2025. That said, we still believe that tailwinds are blowing across all the components driving returns that you see on this slide. Let's start with yields, which are typically the starting point for bond analysts. Yields offered by emerging markets debt remain attractive, around 6 to 7% for broad indices. In some regions, such as Latin America, yields are even higher at above 9.5%. Those high carry levels provide a meaningful cushion and are hard for bond investors to ignore. This is clearly more than what we see in global bond markets more broadly, where yields on global bond indices remain below 4%. We also believe we are at a stage where a more selective approach can be rewarded. From a debt investor perspective, there appear to be more investment opportunities in Latin America and in the EMEA region and fewer in Asia. Additionally, yields still have some room to fall, which should translate into positive price returns. Why is that? Because we believe that central banks in emerging markets still have room to cut interest rates. This is closely linked to improving inflation dynamics. If you look at the chart on the left-hand side of the slide, the green line shows how inflation expectations for 2025 have evolved. We started the year with inflation expectations above 3%, and throughout the year, we saw a series of positive inflation surprises, leading expectations to move lower. Inflation expectations for 2026 are shown by the blue line. As you can see, these expectations are also being gradually revised downward, and we believe this trend has a good chance of continuing. This provides a strong argument for emerging market central banks to continue cutting interest rates, especially since, as shown in the chart on the right hand side, policy rates remain high, both in nominal terms and in real terms, that is, adjusted for inflation. This leaves room for further easing. In addition, fundamentals in emerging market economies have improved recently, including on the fiscal side. As a result, rate cuts should be followed by lower yields. To sum up, our stance on emerging markets debt remains positive. However, selectivity becomes increasingly important. Thanks very much for listening. Trade well. Cheers.